Hello everybody, this is Bob Iacchino from Path Trading Partners along with my co-founder Mike Arnold. This is the rotation zone part 3 for trading crypto and traditional markets. As we mentioned in both 1 and 2, the R zone or the rotation zone, as the title is listed, is something that Mike and I have used in traditional markets for years, and we're noticing the efficacy of it in cryptocurrencies. So we wanted to put these up on our channel and give you guys sort of a 20,000 foot view of what we're doing when we're doing our analysis. So having said all that, let me just start with a quick review. In the last video, you learned a number of concepts using the moving average R zone. Remember that the R zone is useful in markets breaking out of consolidation areas and trending markets. Finally, you learned how the dynamic R zones lining up with price action R zones or GAN levels are the higher probability R zone trades. So let's talk about the number of rotations, because obviously there's more than one when you have an upward sloping R zone. A rotation zone on a given time frame will not hold up forever. At some point, price will not respect the rotation zone anymore and either reverses or goes into consolidation again. After 3 successful rotations, we begin to get cautious with taking trades off of the R zone. Now that's not just a number that we pulled out of the air. That's something that we actually researched, and it's a good rule of thumb on different time frames. After 5 successful rotations, we curtail our trading on that time frame R zone and look at the R zone on a longer time frame for possible trades. So if you think about how that might play out, if you're on a shorter term chart and it's rotated 5 times, you now go up to a higher view. Say you're on an hourly chart, you go to a 4-hour, you'll notice there's fewer R zone retests. And then after that, 5 on a 4-hour, you go up to a daily and you'll notice there's been fewer. That's just the way the time frames play out. So that's what we do if we want to continue to trade R zones. Or you just wait for consolidation and the establishment of a new R zone. So here's an example. And this is showing why you kind of need to be careful after 3 rotations. So here's a breakout. You get a first cross right over here. Then there's a move up, and here's rotation number 1 to the R zone. It's an actual chart. Here you get another rotation up off of the R zone, test number 2. Now look at test number 3. It definitely works, but it gets a little bit less robust. Then number 4 still holds, but once it gets up to the 5th rotation, you're starting to see sideways consolidation. This is an example from a real chart. And they don't all play out this way. Sometimes an R zone could hold up for 20 rotations, sometimes for 1. But our research has shown that after 3, you start to be cautious, and after 5, just kind of hold up and wait for a new pattern or a continuation of the same trend to develop off of static R zones or consolidation. All right, let me turn it over to Mike to talk a little bit about the double cross. Mike, take over.
Thank you very much, Bob. So another important concept that we work with is called the double cross. Remember that the R zone on a higher time frame is more important than the R zone on a lower time frame. So the daily is more important than a 4-hour. A 4-hour is more important than a 1-hour. A 1-hour is more important than a 15 or 5-minute, etc. At times, you may see price trade through the R zone on a lower time frame, which causes the moving averages to cross. The price action then returns above the R zone and the moving averages cross back over. So that's where we get the term a double cross. This double cross many times is indicative that price is reacting to the R zone in the higher time frame. Check your next major time frame to see if price action is in the dynamic R zone. Remember that you're only looking for R zone reactions when the price is trending. When price is in consolidation or congestion, naturally the moving averages will cross back and forth, and this is not what we mean when we're talking about the double cross. And you can go back, we've talked about this in our moving average videos, which are on our channel. Let's give a visual example of this. So, market trending up, came back, tested the R zone, moved up, 8 pushing the price, came back down. Now, you can see it's in consolidation. This is almost a horizontal channel. And when things get into consolidation or these horizontal channels, the moving averages tend to converge in the middle. And when they do, you have these double crosses. And when we say double cross, you could theoretically have a triple cross. Most common is the double cross. So if we look at this, you see it double cross, and then it finally breaks out of this congestion, and then it tests the R zone again and resumes. What did that look like on the higher time frame? Here's what it looked like on the higher time frame. It broke out of consolidation, started trending up, came back to the R zone on the next higher time frame, and then moved up. So on that lower time frame, On this one, you had this consolidation where the moving averages crossed back and forth. Higher time frame, it just returned to the bottom of the rotation zone and then moved back up. That's the kind of thing we were looking for on when we talk about a double cross. Another concept we work with is lining up the dynamic R zones. So this is a powerful concept when the moving average R zones is when they line up on two different time frames. Generally, you will see the price action close to the 8 EMA on the higher time frame, so that could be like a daily time frame, and see price action either in the middle of the R zone or very close to 21 EMA on the lower time frame, maybe the 4-hour time frame. Or you might see it close to the 8 on the 1 hour and near the 21 on the 15-minute. This is a very powerful combination and can lead to high probability trades in trending markets. Let's take a visual look at that. So we have a 60-minute and a 15-minute chart, 60-minute on the left. It moves up, trending, comes into the R zone near the 8, and again near the 8 on this next push. And you see on the 15-minute, it dips into the R zone and then launches off. Those are concepts you can keep looking at. So we're looking at two different time frames, and they shouldn't be like, don't look at like a 20-minute and a 30-minute or a 1 hour and a 2 hour. You need to have some separation, like maybe a daily and a 4-hour, a 4-hour and a 1 hour, a 1 hour and a 15-minute, etc. Those are the kind of separations you want when you're lining up the dynamic R zones. Let me turn it back over to Bob, and he's going to discuss trading against the R zone.
So what does trading against the R zone mean? We have to be very careful of trading against the dynamic R zone in trending markets. This is true especially on higher time frames. As we've mentioned, as Mike just mentioned, higher time frames have more data in them empirically. They're just built in. So more data always is more robust patterns. At any point in the dynamic R zone, prices can reverse and begin to trend again. So it's a riskier trade. If price action is away from the 8 EMA and you are taking a trade, the natural target would then be the 8 EMA. If price has broken the 8 EMA, the next natural target is the 21 EMA or other price action or another price action target, like the end of a clear path, whichever comes first. You just don't want to ignore the 21 EMA. Markets give you natural price targets, and you need to learn to find those. And when you're through the 8 EMA, a really easy one is the 21. Keep in mind the moving averages update every bar, so the targets are moving, and the reward to risk ratio changes with every bar. If we're using the 21 as a target or an 8 in the prior example, remember that it's moving. So in this lesson, you learned a number of concepts using the moving average R zone. Keep in mind the number of times price action has tested the R zone and be very careful after 5 times. If you want to default to 3, go ahead and default to 3. 5 is a good benchmark. 3 is a very conservative benchmark. Check the R zones on multiple time frames to understand how the R zones interact and to understand the double cross principle. Again, we are Path Trading Partners. You're on our YouTube channel if you're watching this, but we'd love it if you would follow us on Twitter at path_trading and like our Facebook page as well. Also, visit us at pathtradingpartners.com. Shoot us an email at support@pathtradingpartners.com and sign up for everything that's free on our website. There's a bunch of stuff up there. Also, I can't recommend enough our podcast, The Money Path, which can also be found on the website. Check out our blog articles, which are also on the website. Cheers, everyone. That's the end of the R Zone series. We'll talk to you in the Path Chats and in our next price action series of videos. Cheers, everyone.